Good afternoon. Today is Wednesday, June 15th, 2022. It is just afternoon here in New York City. Um, Today is FOMC. So we're seeing the VIX falling down initially. We're seeing markets rallying off the VIX fall. Um, let's see what happens in about 2 hours, okay, when they announce the interest rates. It's not just the actual interest rate announcement where we may see some price action happening. It's also when Jerome Powell, the chairman, speaks 30 minutes after that announcement. So if you guys are waiting to do trades, don't just wait until 2 p.m. Eastern. Wait till after he speaks. Actually, even wait till tomorrow. Sometimes we see a lot of price action of reactions from the rest of the world happening overnight. Because right now Asia's closed. Asia's been closed. Right now it's really late at night over there. Europe's closed. And by the time Jerome Powell speaks, they'll also be asleep. They don't stay awake just to watch this. No, all the institutional traders will probably come back in their own local morning times. Read the reports and then make their decisions. So you may even want to wait till tomorrow. Okay, but having said that, let's just go through our game plan. Let's see what we need to change, what we need to keep. And let's talk about some developments here. One of the things that I wanted to say, I know a lot of people are in indexes, and that's what they primarily invest in. But one thing that is on everybody's mind, that especially those who trade options, is that we have a large amount of in the money puts. All right. I mean, this has been the case for a while. This is for June OPEX, and this is what it looks like right now. We'll see. We'll see what happens. We are overhedged, okay? And a lot of people think that a lot of that hedging happened after the CPI report, but actually it was the ECB meeting. That Thursday, after the ECB meeting, after Thursday morning, that's when we really saw a lot of hedging. And I think the CPI report, yeah, I mean, it was a little bit higher than expected, but really most of that action happened here. Okay, I look back at some of the orders on the option flow, and you see a lot of you see actually some puts being bought outside of the bid ask spread, above ask. So there must have been, something must have happened at that point with a lot of institutions. So we'll see, and if as long, my theory is this, it's just an opinion for now. We'll see what happens in a couple of hours. But if the Fed doesn't just, say something horrendous, if Jerome Powell can just not scare the market too much, I can see some of those hedges coming off, and we might go to like 390. Okay, just based on today's positioning. Possibly a little bit higher than that. We will see. All right. Just anticipating what could be. All right. Now, what if he says something and it spooks the market? Yeah, of course. Fresh hedging demand. Even though hedges are expensive, that doesn't stop hedgers demand if they feel like the markets could go further down, or if there's further uncertainty about what interest rates could look like in the future. So just because the VIX is high doesn't mean it can't go higher, right? But if those hedges do come off, again, puts being sold, market maker needs to buy puts, they need to buy the underlying, they need to buy SPY shares to even out their delta. So we may see a little bit of short covering at the end of day. And if that happens, we can see if it continues. And if it continues, we might be able to get back to these ranges, 400, 410. Very possible, maybe at the end of week. If VIX falls, if dealers need to reposition, we will see. All right. There's a lot of IV right now that is priced into this FOMC. I think this is on the SPX option chain. This is the most IV that's been priced in since 2011. So that just tells you, and a lot of that hedging happened in the last 4 sessions. A lot of that FOMC hedging happened starting on Thursday before the CPI, right after the ECB meeting. So this is pretty big. That's why the unwind could be ferocious. All right, it could be. We'll see. All right, and so that's equities. Let's look at some of the other ones. That's QQQ. QQQ is the strongest one right now. The weakest one is the Dow. Today, energy is taking a hit, as well as consumer staples and utilities. So a lot of Dow components are underperforming today. All right. Financials are strong, but the rest are not. Speaking of energy, that is what is on everybody's mind right now amongst professionals. A lot of the morning chatter today amongst the pros is energy. All right. Gasoline, the numbers just came out. The EIA numbers came out. It looks like oil supplies are increasing, but gasoline is still going down. Their supplies are still going down from gasoline. So we're not getting that confirmation, but it looks like it may be slowing down, but of course, maybe not. Maybe this is just a little pause and it keeps going up. All right. I still think that you have to have gasoline supplies go up before this really breaks down. Okay. I'd like to see gasoline supplies come down first. That's just me. But crude oil looks like it could start coming down. And XLE, if XLE is telling us, maybe XLE is front running that. Maybe the expectation amongst equity investors is that oil will fall. One of our members in the morning asked about Exxon put play. I actually like it. I like the idea of this. I'm not going to put it on before FOMC. I'm going to wait, because if we do have a rally, let's say we have an unwind, I can see even oil, because it technically, these are all stocks. Yeah, it's correlated to oil, but even if we have a ferocious rally in the market, stocks could still go up. Even oil companies' stocks could go up. So if we get around here, I might put a 3-month put spread on Exxon. What would that look like? Well, let's take a look. All right. That would be the Septembers. We could do probably the 90 maybe, 90 to 90, 90. The 90-80. If we can get it at 2.5 or less, that would be 3-1 for 90 days. That wouldn't be so bad if we can get this under 2.5. So we would need a little bit of a rally. That way, you also play the skew in your favor. You buy a lower implied volatility option, and you're selling one for that's got a higher IV, so that even if there is a little bit of IV crush, it can work in your favor. That looks interesting. This one looks interesting. So, thank you for whoever suggested this. Um, After he suggested it, that's when I took a look at XLE, and that's when I took a look at all the and the oil chart. And I think, hey, I think it looks pretty compelling. It looks pretty compelling. Um, Again, let's see what happens after FOMC. Just preparing, I don't know if we're gonna rally in this, after FOMC. I'm not sure, but I'm just trying to think 3 or 4 steps ahead just in case, so that we have a plan. But if you're short oil, if you believe this is the top, I mean, this would not be such a bad idea. I have some Chevron shares. I'm probably going to sell some in the money calls that are 3 months out against them. If we get a little bit of a rally in Chevron stock as well. So definitely I'm going to hedge. Okay. That's what I see. Hey, let's look at natural gas. I remember on Twitter, there was a lot of people saying that because of the fire in that export terminal, that was going to be super bullish for natural gas. Well, they're wrong. I think that natural gas was meant for Europe. So yes, I think prices in Europe are probably going to go up because of that, because they were relying on this. But now there's this surplus in the United States, and it doesn't look like they're going to be able to fix that problem for at least a few weeks. Oh, speaking of which, I found out why Dow was having such a horrendous 3 or 4 days. When that export terminal caught on fire, Dow has an interest in that export terminal. That's what it is. Also, too, I mean, there's this market sell-off too, but I think partially the reason why it also was this bad, and that it's not holding up as well, even though all the fundamentals, the dividend payout ratio, all of that is secure. I think partially is because of that interest in that export terminal. Possible, I don't know. Maybe that's just a story I tell myself, but I found that out the other day. So that's with the Dow. I still have our let's see here. I still have the Lotto Leaps that I bought. We'll see what happens. It's at a slight loss. I still have my UVXY call spreads for December. I was about 50 or 60% in the profit a few days ago. Now my profit's only about 20%. But I'll keep them. Even if we do see a bear market rally, which is possible, if the VIX falls. If we see a bear market rally, I still think the major trend is down. The big picture here is still down. Okay. This issue's not going to resolve quickly. It never does. All right? It's not going to be a straight line down. It's going to be down with some chop, down with some chop. That's usually what happens in low liquidity markets. Okay, you see big movements in either direction. All right, but the main trend is down. We could see another just mini little, bear market rally, maybe up to here. Okay, even if it went up to like around here, 42, 4,300, I doubt it. I really, really doubt it will get to here. But if it does, well, we'll be ready with some put call spreads for 3 to 6 months. So any pop, I'm going to start scaling here actually around 4,000, maybe even 3,900. I might start scaling in little by little here scale in faster if we get to 4150, and then at 4200, load the boat. All right. So that's my game plan if we see another bear market rally. Just anticipate. I'm not trying to predict the future. I have no idea. There's no crystal ball to this. All right. Who knows? Maybe you go straight down. All right. Either way, I have some puts. Also, we have our EEM puts. Some of us scaled in. I said that I was just going to scale in with 2. Thank goodness I kept it small. This is the reason why I kept it small, because you never know. You never know. I think the reason why EEM is up is China. Yesterday we took some of us took a lotto puts on this. Should have inversed it. But anyway, last night some industrial output numbers came out better than expected, I think. I think that's the narrative that was on CNBC. The numbers were good. Manufacturing numbers were good or something like that, whatever. But there was other news about, the state media got on TV and they said that they would do whatever it took to support the economy. And so you saw a rally in their market. The Australian dollar also reacted to that news. Australian dollar reacted to that, and it went up. Initially, I think also copper. Yeah, copper also responded favorably to the news. All right. The original thesis, as of yesterday, it was just, generally, this orange line is the Australian dollar, and the candles are FXI, China's large cap. But generally, the Australian dollar will front run some of these movements. And so, you saw further down in Australian dollar before today's, before today's open, it was mostly going down. So the idea at the time yesterday was, well, hey, maybe this is just a little relief and it just goes down. That's why I just did a small lotto. Just bought a couple contracts of the weeklies far, out the money. It was like the 31 strikes. It was like 20 cents. But yeah, their state media comes out. They say they're going to support the economy. Boom, there it goes up. Australian dollar goes up as well, and so in a way brought up EEM. Not much. Let's see how they're doing right now. I told you I'd be buying the March. It's not that bad. It's like less than 10% from where I got it at. That's not bad at all. Huh? Okay. We will see. Obviously, the more we go up, I'm going to scale in some more here. Okay. My goal is to have around 50 of these, 50 to 100 of these. It's not really about the number of contracts, but I'm definitely leaning into this trade. Not so much the EEM, but the put spreads on IWM and QQQ. If we get a bear market rally, I'm definitely leaning into that trade. I will put a sizable position in those. This one, I'll supplement that hedge, because I'm using that to hedge my overall portfolio. Most of my portfolio is SPY shares, so that's what I do to hedge. So I have no problem, putting a large percentage of my spec account into something like that. So I will round that out with some EEM puts at 39. With the dollar going up, even if the U.S. has great markets. Oh, look at that! Wow, look at that! Earlier today we were here. Oh wow. Wow. Okay, dollar's recovering. Well, anyway, the dollar goes up, EEM goes down. All right. So it becomes harder for them to service their debt. It becomes more expensive to import, raw materials, energy, all of that. And, we're already seeing cracks in some emerging market countries, specifically Sri Lanka. It's been on the news already. I think Latin America's next, Greece, Turkey, Southeast Asia, countries like Thailand, they're next. South Africa, they will have their turn. Okay. Also, interest rates going up. I think there will be an emerging market debt crisis in the next 6 to 9 months. Everything's happening so quickly. I thought it would happen, later in 2023, but I don't think so. Everything's happening, much faster. But we'll see. All right, not a prediction. I'm just anticipating. And on rallies, I will hedge and buy put spreads 3 to 6 months out, round it out with some EEM as well. All right. Oh, Magnus is asking a question. At what level would you think about IWM puts on a rally? That's a very good question. Let's go ahead and take a look. I would like to see, and if we pull up SPY right here on this side, I'll pull up SPY. Again, the levels are, if we can get to like 390, 400, I will start scaling in. Now, I do have, I do have a larger account probably than maybe some of you. And if some of you have smaller account sizes, you might want to wait a little bit more. Just because if you scale in here and it takes a large percentage of your portfolio, then you may not be able to scale in here if it gets to that point. And again, when you're a smaller account, you actually have to be a little bit more selective in where you trade. You don't have the luxury of scaling in earlier. You just have to be ultra patient. In my view, if you've got a smaller account, you have to be a lot more patient. And you really have to go after the high probability trades. So depending on your account balances, if you've got some liquidity, if you've got cash, I would start scaling in around around the 180s. Maybe wait till 185, 184, 185. Scale in there, okay, and then scale in around 190 as well. All right, I highly doubt it gets over the 190s. I highly doubt it. But that's where I would start scaling in those put spreads. And again, 3 to 6 months out, hopefully if we rally, some of the implied volatility will drop in some of those further dated puts. Let's just take a look at what November's would look like. Let's see. That would be 165 as a 38 delta with a 30 IV. 38 delta, 30 IV. I mean, these are still quite expensive. Let's see. Yeah, that's quite expensive. The reward isn't right. I mean, I want at least 3 to 1, which means I need this at 125. I need this at 125 so that my reward will be 375 because my max payout is 5 if I do a spread. So I may need to go down further if I were to hedge, if I felt compelled to buy this here, which I am not. I am not compelled at all to buy these puts at this level. I need a little bit of a rally in order for me to really lean into this. Yeah, we're looking at 150, 155 is 120, 155. What's that? That's a 28 delta. We'd have to go out down in the 20s. I really like to keep it. I mean, if it's more than 3 months out, I'll venture into the 30s for the long strike. But the long strike, I like to keep it 40. I like to keep my long strike at 40. I don't like venturing long strikes below 40. Then it just feels like gambling at that point. But yeah, if it's more than 3 months, I might venture into the 30s. But 155, we're venturing into the 20s. And again, it's just because the implied volatility is so high. Let's just see. I'm just experimenting here. Let's look at September, which are 3 months. Maybe we get a little bit of better. Can we keep it for? Oh, I guess not. I guess not. $160, $155. So what? That's a $5 improvement. Is that what it was? Yeah, it was a $5 improvement on the strikes. For what? Sacrificing how much time? Sacrificing 2 months. If I had to choose between the two, I guess I would go with the Novembers. If I had to choose between the two, right now, if I were to do it right now, but I'm not going to do it right now. I will want to wait. All right, I choose to wait. I want to be patient. I want to get that bear market rally, and if we don't, oh well, so be it. So be it. I will then have to miss out. In that case, we will wait to buy the dip. All right, the real dip. Okay, not just like a little bit. Now, here's the thing. All right, this market, I mean, it's going pretty fast. Okay. I don't like to predict what the Fed does. Okay, I'm not trying to predict what the Fed does here, and trying to bet money on what the Fed does is a fool's game. Okay, I'm just trying to anticipate what could be. All right, I think, all right, if the Fed gets a little bit more serious about inflation, comes out with a more, even if they were to go to, let's say, 1%, and then they say, hey, we do this higher rate hike, or maybe they say for the next 3 months we expect to do faster rate hikes. If they come out with that and then they say they're going to wait and then collect data, they'll take a little pause after that, I can see the markets rallying from that. Because now it sounds like the Fed is a little bit, getting more serious about stomping out inflation. Okay, and if that's the case, where they do say that, and we see a rally, and then it comes back down, and if TNX, if the 10-year treasury, if it stops spiking and it kind of settles around 3.5, 3.6 by the time the dust settles, I think 360, around 360 would be the institutional buy level. All right, based on the risk-free rate of being 3.5. Okay. And these are modeling. This is asset modeling based on earnings. All right. You can actually Google it yourself. You can actually download the Excel spreadsheet, play around with different interest rates and different earnings expectations, and you can play around with valuations. But 360, I think, yeah. If TNX goes to 3.5, if they get a little bit more hawkish on raising interest rates faster for the next 3 months, or maybe on this one, and we see a bear market rally, and then it comes back down, boom, 360. That would be institutional buy zone. If let's say Powell says 0.5%, I can definitely see the market selling off, because it just means they don't have a grasp of inflation. They just don't have control of the situation right now. If they come out with half, I can definitely see institutional investors thinking that. And then most likely what that will mean is that 6 months, 1 year down the road, they're going to need more rate hikes than what's needed now in order to fix the problem. Okay, the longer the inflation lingers around, the higher you have to raise interest rates. Back in the 70s, that's what happened. Inflation reared its head in the early 70s, but it wasn't until 79 that Volcker was the chairman of the Federal Reserve. Okay, so he had to raise rates like 60 something times in order to get rid of inflation. So if this lingers, if inflation lingers, then we're just going to need that much more. So that means if the 10-year goes to more 4%, we would be at this level, 340s. Okay, 5%, we're going down to 320. If we have to go closer to 5.5, 6, we're going down to 295, 297. All right. So we'll see. I don't know which one. We'll see. We'll take it one session at a time. Okay. I'm just anticipating of what could be, next 5-6 moves. So we'll see. But that's my plan so far. We've got about an hour and a half until the announcement. Let's see what happens. Let's see where TNX is at right now. Where is TNX? TNX is down. Okay. Let's look at the grains. I still think that if the numbers come out, the crop reports come out, that most of the planters here in the United States, if they don't plant corn, and this next crop report, that's it. After this, they can't plant anymore. The planting season is over after this. So if everybody goes towards soybeans and nobody does corn, if corn spikes, I can definitely see TNX spiking. This, I believe, if corn spikes because of that report, that would be that I can see the fears of inflation being much higher in the coming months. I can see that becoming a thing in the market. So we will see. If corn actually touches this red line. I was actually thinking about doing some corn spreads. I did a corn spread in 2021, back in, I want to say April 2021. So I do these spreads like once a year on average. Last year I did it on corn. The year before that, I think I did it on soybeans. But once a year I do this. I put some spreads on some grains. I think this year I might attempt to do that again, but I want to pull back. I want a pullback. The skew, unlike equities, and here with stocks, for example, if there's a panic, what do people want to do? People want to sell, right? Because they're holding stocks. If I'm a stock, and most institutions are, no institution is short stocks. If they are, they're stupid. They're not going to last long. Okay. Look at the 100-year chart of the S&P 500. What direction is that line going in, right? Most institutions are long-term stockholders, all right? So when there's a panic, there is a need to hedge for the downside, okay? So that's why your skew, your smiley face, let's just go to a SPY chart. I'm sorry. Why am I even trying to describe it when I can show it to you? It's a smile on the put side, especially. You see that smile, right? The volatility skew. Okay, as we get more out the money, skew starts picking up. It starts picking up implied volatility. Okay, on the put side. All right, it becomes more valuable because let's say you have SPY shares, you bought it at 370 and you want to protect yourself just in case if it goes down, right? So there's a lot of demand for out the money puts. That's why we see implied volatility pick up as we get out the money. Okay, that's the skew. All right, everybody's scared of the risk event, and the risk event would send stocks down. And commodities, usually the skew is opposite. It's on the call side of things. All right, it's usually on the call side. Why is it on the call side? Because of shortages. If there's a shortage, then everybody's going to try to get as much supply as possible. They want to secure their supply for supply shocks. Okay, Oil, same thing. Corn, soy, all that. The skew is on the call side. Okay. You know, because with farmers, it also too. It's not like they have, when they panic about wholesalers not buying from them. That's not the case. Usually that's not the case. Usually when there's a panic, it's distributors or people who buy corn that panic. Oh, there's a shortage, weather, something bad happened, locusts, whatever, and they're like, oh well, I need to secure my supply for the next year. Boom, that's when they start hedging and buying calls. So because of that, I think we can use spreads again, vertical debit spreads in our favor, and we can try to use that skew in our favor. So if we look at the September, again, I would want to pull back maybe into the 730s or 740s. But if we did, I mean, some of these look pretty compelling. I mean, let's look at the Delta 40s right now. Obviously, if the price goes down, these deltas will shift down. So then we'll probably be looking at, I don't know, maybe 760s or so. But just as an example, just so we can just get a little bit of an estimate of what's going on. Where is that? 775 is the Delta 40. Okay. So if we were to... let's see, 2550, 825, maybe the 825s. That's not bad at all. That's not bad. 4 times, that's 3 to 1. That's exactly 3 to 1. Well, it was. It was just a tick ago, but it's about 3 to 1. Reward to risk for 72 days. That's not bad. But again, I'm gonna wait. I'm gonna be patient. I want to be patient. But what if it corrects down here? At least this way I can manage risk better. If it falls down to here, I buy the spreads, and if it keeps coming down, 1 or 2 days, boom, I can just get out with a small loss. Okay, this way it makes my risk management easier. So I want to buy here, 1 or 2 days down, it closes below it, cut my loss. It'll probably be very small and get out. Okay. It's what they call row, right or right out. You're right or you get right out. Okay, and I'll use call spreads for that. Right here. All right. Let's look at some of the because we got FOMC coming up. Let's look at some stocks. I know some of you have been asking for individual stocks. Amazon. Oof. I mean, we will see. If this bear market continues, though, there's still a lot of hot air left. Amazon. And some of you, actually, I know some of you from the old Discord, I used to talk very highly of AWS, and I always said AWS has the MB seal of approval. Well, I am taking that seal of approval away from AWS. I no longer think AWS is the champion in that segment. I think now Microsoft is out to eat their lunch. I think Microsoft will outcompete them. Azure now has MB seal of approval. If you go through their earnings, I think Microsoft is definitely eating their lunch. I think they'll outperform in the long run. Let's take a look. Apple. There's no trade here until FOMC, But one trade I am looking at, though, speaking of Microsoft, is if if we just talked about those value levels where I would buy the dip, 360 or down, 360, 340, all those levels. Not a bad idea to buy Microsoft calls Delta 40 maybe 6 to 9 months out at those buy the dip levels. Not a bad idea. Not a bad idea at all. I saw a lot of demand. I've seen a lot of demand for chip stocks today too. Semiconductors in general are just doing very well today. Oh, they were doing better though. Something must have happened. Maybe there's a little bit of it's just fading. The market's kind of fading because volatility is going up. Probably hedging for FOMC. Some more hedging, just last minute hedgers. Nvidia. I know a lot of you like Nvidia. We'll see. We will see. I like that setup. Distracted Dad. I think this was you. When I think you're the one that said the puts for XOM. But I like this. If this rallies a little bit, I like that put spread. I like that R to R, the reward to risk. I like that. I think that will be good. Just a last minute check. EEM. Okay. FXI. Oops. Let's see. Okay. What else? The dollar. Let's just look at the dollar real quick. Still strong. Okay, we'll see. We'll see what happens, and we'll go from there. Any questions? Anybody want to see something else real quick? I see somebody typing. KR. Oh, you want to see KR? Oops. What was the ERIV play? Which one did you buy? It's a food play? Okay. Moof. You bought the 53 calls? Ooh, man. So you think it's going to go up? If I were compelled to gamble with something like this, which I'm not, I am not compelled to gamble on this at all. That's just not my style. But if I were, no, I just wouldn't. I mean, okay, good for you. I mean, if you want to do it, good luck. Good luck. I hope you strike it rich with that. Okay, that's a little too exotic for me. If anything, if you wanted to be long on this, I'd sell the puts. Actually, I wouldn't even buy. I'd sell puts, put spreads. What is this? What delta is this? 20, 21? Let's see. %. If you want to make 20%, almost overnight, I'm sure if it just pops up after ER, all this is going to get sapped to zero, or close to it. So if you want, you could sell the 47.46. It's a delta 23. It would have to fall $3.77 before Friday, before you're challenged on that 47 strike. And for $1 of collateral, you're making 20 cents. You're making 20% in what? 2 or 3 days? If that, maybe even most of it, probably it'll go to like 5 cents if it rallies tomorrow. And IV gets sapped. You're making what, 15% overnight? 10-15% overnight? Again, hey, remember what I told everybody? All you need to do is make 2% a week compounding. Take $1,000, add $100 a week to it, compound it 2% a week, and you'll have $1 million in 5 years. People always want to be doubling their money and double, triple their money overnight. That's stupid. All you need is 2% compounding a week. That's all you need. All right. This is a 20% spread. If you put only 10% of your portfolio into this, that's your 2% quota right there you can make overnight. Boom. And you still got 90% of your portfolio to play with. Put the math on your side. You've got over pretty much, almost 80%, let's say 70% chance that you're going to collect the full profit. I don't think it's that bad. And that's based on option prices. If you are very confident that this will go up, you can collect your 20%. And if you're wrong, if it goes down, that IV still gets zapped out, and you may still be able to get out just at a minimal loss. All right. So if you were to be compelled to bet on such a short-term direction on a stock like this for ER, like a binary event, right now, just with the way the implied volatilities look, I'd be selling these. The math is on your side to sell and collect that theta, collect that implied volatility crush. That's just me. All right. What else? Any other questions? Trades you want to look over? Anything else? All right, I'm going to turn the recording off, and if you guys want to, you'll be able to ask me some questions live. All right. So let's trade safe. All right. FOMC is in about an hour and 10 minutes. The announcement. If it were me, I would wait until after Powell is done speaking, or even wait till tomorrow to start opening trades. Okay, so because you never know what could happen overnight as well. All right, let's get this money together and stay safe, and I'll be back soon.